Once a year, you look at your portfolio, and if it's away from those percentages, you bring it back to those percentages. So you rebalance to 60-40 every January. And look what happens during this period of buying actual index funds, a Russell 3000 fund, which is often called a total stock market fund, and a Lehman aggregate. It's actually the Barclays aggregate now. I don't know why they changed the name. Well, at any rate, it used to be the Lehman aggregate bond index. And what you notice is that the not rebalanced portfolio gave you 10.7%, and the rebalanced portfolio gave you 12.2%. Now, what's the alchemy that does this? How do you get a higher rate of return by just doing this rebalancing? Well, just think what was happening. We're rebalancing every January. So it's January 2000. Stock market was at the roof. The Federal Reserve was increasing interest rates, so bond prices were down. You look at your portfolio, it wasn't 60-40, it was closer to 80-20. You had 80% in stocks and 20% in bonds, so you take a little money off the table and put it into bonds. You didn't know it was the top of the market. Nobody knew it was the top of the market. But you knew you were unbalanced, and you take some money off the equity table. It's now January of 2003. You don't know that the bottom of the market was in October of 2002. But what you do know is that the Federal Reserve had reduced interest rates, your bond prices were way up, your equities were way down, and so you had about 55% in bonds and 45% in stocks, so you sold some stocks and bought bonds. And that's why this alchemy works, that in any case where you have these very volatile markets, and if we are in a continuation of a tough period of very volatile markets, rebalancing is always going to reduce your risk in terms of the volatility of your return, and in markets that are very volatile, it will tend to increase your average return as well. Okay, another lesson that I hear all the time is what we've learned from the financial crisis is diversification doesn't work anymore. It's clear that diversification doesn't work anymore. Look, we've just had markets going down. The U.S. market's down, Europe is down, Latin America is down, China is down. All the markets go down. Diversification, what happens, in fact, the correlations of markets go to 1, particularly when they're going down. Diversification fails you just when you need it most. We don't want to diversify anymore, and that's the end of the story. Well, let's take the argument as it is. Are all the markets so correlated? Let's take a couple of markets. These are rolling correlations. Let's take the correlation between the bond market and the stock market. Well, the correlation of the bond market and the stock market has become negative. I mean, this is a great diversifier. Bonds have become an even better diversifier. So it's not the case that all markets have moved up and down together. Bonds have been a great diversifier. Gold has been a great diversifier. Gold is basically protects you from Armageddon, and if in fact the world, if Greece completely defaults at the end of the week, and there's a run on Italian bonds and Spanish bonds and so forth, gold will probably be over $2,000 an ounce. I'm not going to tell you to go out and buy gold, but the point is diversification is not dead. There are assets that help you diversify. And even when the correlations are very, very high, that doesn't mean that you shouldn't diversify, because let's look at the correlations between emerging markets and developed markets. Now you can see that they tend to be very correlated. That is to say, when the developed markets go up, emerging markets go up. when developed markets crash, emerging markets crash. Again, during this terrible lost decade where developed markets gave you a 0 rate of return, even though the correlations were very high, you would have been very happy to have some emerging markets in your portfolio because they gave you a 10% annual rate of return. So even though the correlations were high, this doesn't mean that you shouldn't diversify. So again, that new lesson that we are supposed to learn, I think, does not hold water. Now let's put these things together. We know that this was the first decade of the 2000s was the lost decade for investors. People got disgusted with the stock market. You didn't make any money in the stock market. But what if you did, and I'm taking these percentages from my random walk book because I've got percentages that I recommend for a 50-year-old investor. And the percentages that have been in random walk for the last 10 years have been a third bonds, a third U.S. stocks, 17% in emerging markets, foreign, and 17% in developed foreign markets. I'm not saying this is necessarily the greatest allocation, but that's the one that I had been recommending. So let's take the one that I suggested people use in the old lessons of random walk. And we'll do two things. We'll do that versus just holding undiversified 100% U.S. stocks. So you start with $10,000 in the U.S. stock market. We know it was a terrible decade. You didn't make any money. You ended up about the same place where you were at the beginning. But what if you diversified that way and you rebalanced every January? That's the calculation. You rebalance every January, you had that diversified portfolio, and what you notice is you almost doubled your money during that decade, despite the fact that that was one of the worst decades for investors, probably one of the worst that you've been through. You have to start to think about, going back to the 30s to think that you had worse investments than that. So I would say that diversification does work, and so does rebalancing. The next message that I hear when I go to conferences is, you don't want to buy index funds anymore. These are tough markets. We have to go active. And what I would suggest to you is the one thing, I think all of us who talk about investing and give investment advice have to be very modest about what we know and don't know. But I will tell you the one investment maxim that I am absolutely sure about. It's one of the few things I'm 100% sure about. And it is the lower the fee that I pay to the purveyor of the investment product, the more there will be from me. That's the only thing I'm absolutely sure of. So I've been trying for a long time to look statistically, how do I find the best active managers? Are they the ones that performed best last year, the last 2 years, the last 5 years? Is it entirely a style thing? And the one thing I can come up with statistically that works is the funds that have the lowest turnover, do less buying and selling, and have the lowest explicit management fees do the best. And this divides it into quartiles. Again, the period 95 through 2010. The funds, and these are active funds now, that have the lowest quartile of expenses have the highest returns. So the one thing that if you disagree with me about index funds, you want to go into active funds, you want to pick the best ones, the best way that you can do it is pick the ones that have the lowest turnover and the lowest explicit management fees. And of course, the quintessential low-cost funds are index funds that simply buy and hold a large portfolio of stocks and the kind of index fund that I recommend are the broadest index funds possible that hold the entire market. Now, I had, in the random walk book, argued for index funds because I had believed in what is called the efficient market hypothesis. In other words, I believe there are a lot of smart people out there, and information gets reflected pretty quickly into market prices. If there's a biotech company in South San Francisco that develops a cure for cancer, the FDA approves it, it looks like it's going to be a blockbuster drug, and the stock ought to be worth double what it was before the FDA approval. It'll double right away. It's not going to double slowly over time, because people will realize that any purchase they make before it doubles will guarantee them profit. But even if you disagreed with me, and there are certainly a lot of people who disagree with me that markets are really pretty darned efficient, even if you disagreed with me, indexing has to be an optimal strategy. Because when you think about it, let's think about all the stocks in the United States market. All the stocks have to be held by somebody. So that if there is some investment manager that is holding only the stocks that did better than the market, there's got to be some other investment manager who is holding the stocks that did worse than the market. We don't live in Lake Wobegon. We cannot all be above average. So if 8% is the market performance over a period, there'll be a distribution. There'll be some that do better, there'll be some that do worse. But now let's say that the average active fund